Glass breaks, voices yell, flashbulbs go off. The Treasury Secretary bursts out of a closed-door press briefing. His tie is crooked. He's gripping papers, face flushed. Scott Bessant isn't walking. He's storming. Cameras catch just 5 words. We sent the letters. 100, and with that, Washington falls silent. 100 countries received what Bessant calls tariff letters. But critics call them something else, ultimatums, sent without negotiation, discussion, or diplomacy. Just a sharp demand: renegotiate trade under U.S. terms or face tariffs as high as the 1930s. Bessant says those letters would snap tariffs back to April levels, with some soaring to 50%. But here's the first problem. None of those countries had even agreed to talks. Vietnam, Korea, and Mexico may be dependent on U.S. trade, but most others? Silence. No replies, no statements, no outreach. The message? Either they don't think Trump will follow through, or they've already moved on, and that silence is telling. Bloomberg's global trade trackers report that over 63 of the targeted countries now trade more annually with China or India than with the U.S. That's not political. That's math. Why would they enter lopsided trade talks with Washington when they already have lower tariff alternatives through BRICS? It's not resistance. It's apathy. And that's where the timing gets dangerous. Trump has now delayed the tariff start date. Again. July 7th was the first deadline. Then, August 1st. Now Bessant says it's a signal, not a deadline. But Wall Street isn't buying it. The moment Bessant's remarks hit Bloomberg Terminal, the S&P 500 dropped 2.1% intraday. Not because of the tariffs, but because of the growing uncertainty. Add in a $3.4 trillion tax expansion passed just weeks earlier, and fears of inflation fueled by national debt are now baked into investor expectations. There's no clear plan, no direct outreach, and no one on the other end picking up the phone. Meanwhile, another battlefront opens: BRICS. Trump's latest directive adds an automatic 10% penalty tariff on any country backing what he calls anti-American BRICS policy. But here's the problem. There's no clear definition of what anti-American means. Does it mean de-dollarization, shared infrastructure, joint settlements? If so, even Germany, a NATO member, could be penalized for trading with China using RMB. Brazil might face double tariffs just for being part of a BRICS reserve system that hasn't even started yet. That system, designed to trade raw goods like oil and lithium using a shared non-dollar currency, is still in development. This isn't a firm policy line. It's a moving target, and it's aimed at any country trading outside the dollar. And that's the deeper irony here. The U.S. built much of the global trade system: WTO, IMF, SWIFT, and countless bilateral deals. Now it's trying to punish the same system it once controlled, with BRICS forming a parallel financial network, focusing on non-dollar trades and raw materials. The very architecture built by Washington is turning against it. Interdependence, once an advantage, has become a trap. Let's pause here, because what Bessant calls a trade plan is starting to look more like a containment strategy with no clear lines. This isn't diplomacy. This is a forced marriage under a countdown with no partner at the altar. Consider the raw stats. In 2000, the G7 made up 70% of global GDP. Today, just under 43%. BRICS, up from 18% to 34%, and still climbing. China alone is set to hit 19% of global GDP by 2029, says the IMF. And if Indonesia, Egypt, and Saudi Arabia join BRICS by 2026, the group could control 46% of the world's output and more than half its key minerals. So really, what power do tariff threats even hold in that kind of world? Washington still says its size and consumer base gives it unmatched leverage. But leverage works both ways. The U.S. imports $3.1 trillion in foreign goods every year, according to the Census Bureau. Despite the trade fights, China remains America's top supplier of electronics, batteries, medicine, and auto parts. Sure, Bessant's tariffs might hurt exporters abroad, but U.S. companies will bleed too, hit with higher costs, disrupted supply chains, and retaliation. And retaliation isn't theoretical. In 2024, China-BRICS trade hit $650 billion, a 5.2% increase over last year, per China's Ministry of Commerce. That's in the middle of global slowdowns, U.S. rate hikes, and weak demand. So picture what happens with even a slight shift in global supply chains under tariff pressure. One executive order, and U.S. allies could start rerouting toward BRICS. And once those ties are made, they won't be easy to undo. In fact, it's already underway. According to Reuters, more than 37 nations have activated RMB-based trade settlement systems since 2023. The Gulf Cooperation Council just approved crude oil contracts priced in yuan. Brazil and Argentina now conduct over 40% of their trade with China outside the US dollar. This isn't speculation, it's already happening. The result? A slow but steady decline in global dollar demand, and with that, weakening appetite for US treasuries. Let's test that idea. Bloomberg data shows that foreign purchases of US treasuries fell by $289 billion in the past year. The biggest pullbacks? From BRICS nations and their closest trading allies. China alone slashed its holdings by $12 billion, the fastest reduction since 2016. The reason's simple, less dollar-denominated trade means fewer dollars that need to be recycled into U.S. bonds. Demand drops, treasury yields rise, and now Bessant's tariff campaign begins to rebound back toward home. But China isn't just selling off treasuries, it's buying gold. In June alone, the People's Bank of China added 70,000 troy ounces of gold. Over the past 8 months, they've stockpiled more than 34.2 metric tons, according to official statements. Why? Not for yield, but for trust. Gold carries no U.S. political risk, no sanctions baggage, no debt ceiling drama. That's why it's becoming a preferred store of value across BRICS. Here's the irony. A metal the U.S. once demonetized is now China's financial weapon of choice. Even Europe is shifting. A German church pension fund recently allocated $50 million to a China equity fund based in Hong Kong, per the Financial Times. Ostensibly, it's for exposure to high-growth and undervalued Chinese tech and industry. But the symbolism is bigger, a NATO-aligned institution putting capital in a market Washington labels a rival. So, while Bessant sets tariff deadlines, BRICS is quietly absorbing Western capital, and the markets are noticing. Year-to-date, the Hang Seng Index is up 21.3%. The S&P 500 just 6.7%. This doesn't mean Wall Street is crumbling, but it does show that global capital is diversifying. Investors are starting to price in long-term instability in U.S. fiscal and trade strategy. Because when volatility becomes systemic, yield isn't enough anymore. Investors chase stability, not temporary spikes, which makes China's next move even more telling. According to Bloomberg, Beijing is considering an expansion of the southbound bond connect, which would open the door to up to 1 trillion yuan, about $140 billion US dollars, in outward flows to global bond markets. That would partially loosen capital controls, allowing Chinese institutions to buy Eurobonds, U.S. corporate paper, even treasuries. On the surface, it might sound dollar positive, but in reality, it's about Wall Street displacement. The goal, says the PBOC, is reciprocal flow, to turn Hong Kong into a full-scale financial center that pulls in foreign capital while offering outbound access, a system that works without needing Wall Street. And with more BRICS sovereign bonds set to list on the Hong Kong exchange, that ecosystem is becoming more self-sufficient and potentially competitive with U.S. markets. Meanwhile, Trump's fiscal policies risk setting off a dangerous loop. His latest tax bill added $3.4 trillion to the U.S. deficit, according to the Congressional Budget Office. At the same time, inflation forecasts jumped 1.7 percentage points for 2026, but the deeper issue may be distributional. The Joint Committee on Taxation reports that the top 20% of earners see a 2.3% income boost under the new law. The bottom 20%, a 2.3% loss. So, just as tariffs drive prices up, lower-income households lose purchasing power while the wealthy shift capital offshore. And when the middle class can't spend, growth slows. Retail stalls. Small business investment dries up. This isn't a forecast, it's déjà vu. It's the 1970s all over again, only with new players. Add projected tariff-fueled inflation of 15 to 20%, according to the Peterson Institute, if the August hikes kick in, and the pressure on household budgets could become, well, unbearable. And yet, BRICS economies are doing the opposite, expanding credit, lowering rates, and backing trade with subsidies. The contrast is sharp. The U.S. tightens, while BRICS accommodates. And here's the twist. The very system BRICS is now using to displace the U.S. was built in America. The U.S. exported global trade routes, digital finance rails, dollar alternatives, and infrastructure models, tools that are now being used to reroute around it. This isn't a revolution, it's a remix. And if the US keeps threatening instead of competing, the thing that isolates it won't be tariffs. It'll be gravity. Will BRICS back down? Will Trump recalibrate? Or are we watching the final cracks of the old global trade order? Let us know in the comments. Thanks for watching.